Welcome to the Del Walmsley Radio Show. Listen and grow as Del questions the status quo, encourages you to think differently, and empowers you to make a better life. Get ready as Del challenges core beliefs, seeks the truth, and reveals the roadmap to the lifestyle you really want. And now your host, multi-millionaire, national award-winning investor, CEO and founder of Lifestyles Unlimited, Del Walmsley.
Welcome to the Del Walmsley Radio Show, where the hype ends and the help begins. I'm your host, Del Walmsley, and as always, we're working on your financial freedom. Today, my friends, I'm going to take myself way back to the beginning thought processes that got me started in real estate investing, and share with you just the basics of what it is that I do and why I do it the way I do it and why I teach it the way I teach it. Because what we developed over these 33 years has become too powerful. So powerful that people are using it to go out and make massive fortunes, to develop and build large companies, very large companies. And that wasn't what it was intended to be. It's still there. That's happening. I'm not about to try to stop people from using resources and ideas and assets in a way that I never even dreamed of wanting to do it, but I want to bring you back. Why do I want to bring you back? You see, because I think as I sit here and I make massive amounts of money compared to what I'd ever thought I'd ever make in my life, as I have wealth beyond what I ever dreamed of having, I don't want to lose the fact that I have it because I never swayed away from some basic rules. And today I kind of want to share these 7 basic rules, if I can get them all out today, about why I do this. That's kind of important to me. So let's go ahead and let's get started and let's understand this. The first rule that I have comes out of why I started real estate investing in the first place, and that was that I had just lost quite a bit of money in the stock market. The reality was I was doing it in a market where the place where it was just going up and down and up and down and up and down, but I was catching it right for a long time. And then all of a sudden, Black Monday. And that's the problem with the stock market, is there is that possibility that something happens, a black swan event that just destroys the market, and a very large amount of your income is gone. Period. Just disappears. And that happened. And so I said to myself, look, I'm never going to invest in something that's gambling again. And you say, well, I'm not gambling. Yes, you are gambling. It's just a different word. But the biggest reason, number one, was I told myself, I'm not going to lose any more money. And so rule number one is keep your principal. Don't lose your principal, the original investment. Don't lose it. And so I decided to look into all different kinds of businesses, and I did. I looked at, franchises. I looked at all kinds of things. And they all came down to be a lot of work and very expensive to buy, to set up, and to get started. And many of them didn't even guarantee there'd be any profit even from the beginning. So it just didn't make any sense to me. But my investigation into real estate proved to be completely different. You buy a rent house, you put a tenant in, it pays you money. Boom. Pretty simple. But more importantly, you owned an asset. It's a real tangible asset. It's there. It stays there. It continues to make you money if you know how to operate it and if you're a good business person. And, there is something to that. You do have to know how to operate it correctly. And that's why I set up the training classes, because a lot of people did real estate, didn't know what they were doing. The next reason to get into real estate investing is the most important reason, I believe. Well, no, not losing money is a pretty big one. The second one is cash flow. And I didn't even realize how important cash flow was until I had cash flow. Every other investment I've ever had, whether it be the stock market, my 401k, my IRA, the other types of investments, they didn't pay me any money. Now, I will say that when I had the CD, that did pay me money until the guy went out of business. But getting money in the mail is an amazing concept. I can't even tell you the feeling I had and the feeling most people have when they first buy real estate. And then all of a sudden, there's money in the mailbox. Literally, people sending you money. It's just hard to believe. And when I set up my first rent house and all of a sudden these checks started coming in, and of course I had to pay a mortgage payment. I had costs I had to put out. But it was so different because when I was working for corporate America in the health club business, we sold memberships. That's how we made money. And we would sell $100,000 a week in memberships and send all that money. I remember bundling that money up, the checks and the credit card receipts, and putting them in a mail envelope and sending up to corporate office, sending them $100,000 a week. A week. After doing that for 4 or 5 weeks for the month, it was ungodly. $500,000 we'd send up to the office, and then we'd get our check back. And I'd get my paycheck. And it was about $3,000. And I thought, my gosh, would I love to have the $100,000 that we sent this week or the $400 or $500 we sent this month instead of the $3,000. I go, it's just ridiculous. I'm giving them hundreds of thousands of dollars, and they're giving me $3,000. Now, I know that's employee mentality. I understand that. But that employee mentality burn was a big enough burn in my life to realize I didn't want to be an employee. I wanted to be the owner. I wanted to get the big money on the other side. And when I bought my first rent house, and they were sending me $500 a month in the mail, and my payment for the mortgage was $200 a month, and I had that extra money, I go, my gosh, in fact, I think my payment was $220. I had $280 a month positive cash flow. I was making more profit than the mortgage company was getting. And part of the mortgage payment was principal reduction. So not even all the $220 payment was, interest. Some of it was just paying the mortgage off, which in essence is a profit to me. And I thought to myself, why did I ever put money anywhere that didn't pay me money? Now, let's go down this further. You realize the reason you get up and go to work every day is because you need regular, reoccurring income. And it has to be realized income. Can you imagine if you went to your boss and said, boss, you're taking 10% of my money right now, putting it in a 401k. Could you put 100% of my money in the 401k? You would never say that because you can't survive. You need the 90% to survive on. You need cash flow. And you can't quit your job and you can't retire because you can't replace the cash flow. The second you replace the cash flow, your job no longer has a hold on you. It no longer controls and manipulates your life. After I started making money on the side through real estate, my boss yelling at me meant nothing to me. It used to bother me, drive me crazy because I think this guy could fire me anytime he's got me and he's got my yin yang in a vice. There's no way I can do anything that this guy can't crush me because I need a job. And I actually particularly like the job. So if he crushes me and I lose the job I like, it's not only do I lose the money, I lose what I like to do for a living. It was terrible. But as soon as I had money coming in, and I could tell that if I lost the job, it meant nothing, then all of a sudden the job got to be fun. I remember one time my boss called me up and was yelling at me, screaming at me. And I just took the phone and stuck it in the drawer, literally stuck the phone in the drawer. If you can imagine this. And I was in there with my staff. I was running a health club and I was in there with my staff and this boss was screaming at me. I just stuck the phone in the drawer and let him scream to himself. And he screamed to himself for 5 or 10 minutes. I don't remember how long it was. And then I took the phone back out and said, hey, look, I got somebody here. I've got to sign up for a membership. I got to go. And I just hung up the phone. And that was it. The guy never yelled at me again or got close to yelling at me again because I'd never let him. That's the power of cash flow. And if you don't have cash flow, no matter what investment you have, go, I've got a 401k. Go, what good is the 401k? You don't get paid by the 401k. You pay into the 401k. That's not an asset. That's a liability. That's something you have to fund. Anything you have to pay each month is a liability, which means your personal residence is not an investment. It's a liability. You're paying into it. Robert Kiyosaki pointed that point out. Now, I know logically, theoretically, it's an asset, and then it may appreciate in value. But that doesn't mean it's making you any money. It's not an investment, right? And so everything you're invested in, none of it's paying you money. I have people do this in the seminar all the time and say, hey, look, take all the money you make each year from passive investments. That means money mailed to you in the mailbox that you can spend, spendable income, not a piece of paper saying, hey, the number on your piece of paper is larger, but actual money you can spend. And most people have next to none. Then I say, take all that money you make each year and divide it by your net worth. And what most people find across the board for 30 years is they make less than 1% return on their net worth. How can you ever retire if you're making less than 1% on your total net worth? No matter what you have, you can't make it on that. We'll take a short break. Be right back at the Del Walmsley Radio Show.
Teaching you with a roadmap to creating the lifestyle you really want. Keep listening. The Del Walmsley Radio Show returns in moments.
What is Del Walmsley, CEO and founder of Lifestyles Unlimited, up to in today's market?
I'm out there right now looking and buying everything I can get my hands on for a better deal than what I could get it for a week before. And I'll just keep buying. I did that back in 2008. I bought a property that was worth $35,000 a door. I bought it for $26,000 a door. Next month or so, I bought the same age property, and I bought it for like $19,000 a door. But by buying at 26 when they were getting killed from 35 down to 26, buying at 26, let the broker know I was a buyer in a downward spiraling market. And so from that point on, I bought 3 or 4 more. I can't remember exactly. I think it was 4 more I bought from there. And the brokers were just bringing them to me, go, look, you seem to be the only guy buying right now.
Are you ready to take advantage of the wave of opportunity coming to those who know what they're doing? Join us for the free online workshop at lifestylesunlimitedworkshop.com.
You're hearing the Del Walmsley Radio Show. Want more life-changing knowledge? Access our podcast and listen on demand at lifestylesunlimited.com under the radio tab. Now your host, Del Walmsley.
Welcome back to the Del Walmsley Radio Show. Today we're talking about the base reasons why I invest in real estate and why you should invest in real estate also. We've already covered, number 1, never lose money. And number 2, there's got to be cash flow. So let's talk about number 3, which is captured equity. I don't know too many other investments that you can do this, especially not the stock market, but let's just go for an example. I go out there and I see a house, and the house is worth, and I'm going to make up a number because the numbers just are insane nowadays. But let's say a house is worth $300,000, and somebody messes it up. It's just dirty, it's ugly, whatever. And or maybe there's some repairs that need to be made. And they put it out in the open market, and it would appraise if it were perfect for $300,000, but nobody's willing to pay that because it's so bad. So you end up buying it at a reduced price because of that, and you buy it for $250,000. Now you have to go back in there and spend $20,000 to fix the stuff that's broken and clean it up. So now you own it for $270,000, but it appraises for $300,000. You've made $30,000. And with leverage, you could have purchased that property with very little out of pocket done correctly, and you might have nothing in the deal when it comes down to it. So you're looking at a situation here where I want you to go to the stockbroker and say, okay, look, I want to buy $300,000 worth of stock, but I want to buy it for $270,000 because I can do that in real estate. I can make that gain, that 10% gain, $30,000 on $300,000. I can make a 10% instant gain by just buying correctly. So go to your stockbroker, go, I want to buy correctly. I want to buy $300,000 worth of stock for $270,000. And they can't do it. And even if they could do it, they wouldn't do it for you. They do it for themselves. So it's not going to happen. There's no way you can make instant gains by buying stocks, but you can make instant gains by buying real estate. And I do it all the time. And I've done it my whole life. And it still occurs. Now, it probably doesn't occur in large industrial in real estate, like a large apartment complex, because there's so many people out there that know how to do it and looking for that opportunity to do it that they bid the price up even on stuff that shouldn't even be purchased for the price they purchase it. The way they make money is an additional way to make money, which is what we call forced depreciation. And that's where you buy something that's worth, let's say, $10 million. And I'll make an easier number for people to perceive. Let's say it's worth $1 million, and you buy it for $1 million, and your goal is to make it worth $1,100,000 or $2 million is possible. And this happens by going in there and increasing the income, raising the rents, reducing the vacancy, and controlling the expenses. Now, you don't really ever reduce expenses. You control expenses. For example, your property taxes are probably going to try to go up every year. You're going to fight that every year, so you're going to control those back down again to where they should be. Same thing with your insurance. Your insurance is going to want to go up every year. You're going to shop the insurance and try to get the best deal you can get, although you're probably not going to get a great deal in a marketplace like now because there's been so many hurricanes and so many tornadoes and so much fire in California. The insurance companies are raising the rates because they've had so many claims against them. But you're going to fight that down as low as you possibly can. And we've got stories about that. That's a whole nother day's story right there. So this is, forcing the value of the property to go up. So you're either buying the property below what it's really worth, or you're buying it, making a few changes that force the value to go up, so you have this instant gain. Now, you just can't do that in most investments. You go to your annuity guy and say, hey, I want to buy an annuity for 20, 30% less than what it's worth. They can't do that. That's the whole point, guys. You can't do what you can do with real estate with other investments. It just doesn't work that way. So we've already said 3 benefits you don't get from any other investments. You don't get the security you get with holding assets. Now you say, well, I have gold. That's pretty secure. Okay, it's pretty secure. Let me explain to you how secure gold is. Let's go to commercial. Robert Kiyosaki's on this commercial. I've really lost all respect for Robert Kiyosaki when we went on and sold gold and silver. Here's what he said. Silver is right now the most valuable thing that has the most potential for a run. Now, listen carefully to what I'm saying. I hope you have enough intelligence to get this. If silver just goes back to where it was at its peak, you will have made 100% gain. Now, what did I just say? What did they just say? That silver or gold, and they say it for both of them, is down 50% from its peak. And if it goes back up to its peak, you'll make 100% gain. But wait a minute. What happened to the people that owned it at its peak? And now it's down here where you can make that gain on it. Well, somebody lost all that money. The greater fool people did. The ones that thought they were so smart because gold was such a security blanket in an inflationary world. Didn't sound like too much of a security blanket to me. Sounds like gold's pretty scary. My real estate never did that. My real estate never dropped by 50%. You say, well, Dell, in the 2000, 8, real estate went down 30, 40%. I go, yeah, man, I bought a ton of it then. So, well, didn't your other real estate lose value? I don't think so, because I never sold it. And during the same time, I rented it and we made money and I made a profit on it while I bought stuff really cheap and made a ton of money on it. Right? So, man, there's just so much more available through real estate. So, the next thing is a little weird thing called depreciation. Depreciation is crazy. Somebody passed a law umpteen years ago that said that real estate is depreciating in value and you should be able to write off that long-term depreciation. Well, you can't write off the long-term depreciation on your home. You can't write it off on your car. You can't write it. But you can write off that long-term depreciation on real estate. Now, even crazier, if you're a real estate professional, which I am, then you can take it against your earned income. We captured 10 or 20 or 30% up front in equity. We have got cash flow of 10%, anywhere from, on a low apartment deal, 5% to a high 15, 20% on a house. And we've now got another 18% on tax benefits. We're talking about making 50 to 100% return on these deals, not even getting into the long-term sale. It's unbelievable how much we make on this real estate. And there were 7 reasons we've covered. We've worked our way to one that I would call mortgage reduction. And mortgage reduction means that when you have a mortgage, you're paying not only interest each month, but you're paying down the loan. And this reduction in loan is actually a profit to you. What's interesting is that you're buying something and you're not paying for it because your tenant is paying the mortgage for you. So it's just so weird that you put a tenant in there. Not only do they pay you a profit, they're paying your mortgage off for you. And this mortgage reduction adds up. Now, when you have one little rent house, it's not a lot. But when you have millions of dollars of real estate, that mortgage reduction is quite a bit. And it adds up very quickly. Even if you do nothing but just hold on to the house, eventually you're going to have a gain because this mortgage is going away, meaning the amount of equity you have in the house is going up on a regular basis. Now, let's add to that something called appreciation. This is unbelievable. This is like I talked about the stock market. I remember when the stock market was 3,000 or 6,000 and so forth, and now the stock market's up to 20 or 25 or 30, whatever it's at. That appreciation, which is really an inflation-based situation, is occurring, which means this asset is inflation adjusted. So the first rent houses I purchased were 3-bedroom, 2-bath, 1 or 2-car garage houses. Those houses, when I purchased them, I purchased for $25,000 a piece back in 87, 89, something like that. I don't remember the exact date. Whenever the Black Monday stock market crash was right after that. And those particular houses today, you couldn't buy them for $200,000. The median price now in Houston's over $350,000. You couldn't buy a little starter home for under $200,000. You can't find them. If you did, you better buy it. If you find anything under $200,000, no matter how small it is, you probably need to buy it. But even so, $200,000. I paid $25,000. What amount of gain is that? Well, from $25,000 to $250,000 would be a 10 times gain. That would be, well, let's figure it out. From $25,000 to $50,000 would be 100% gain, right? To 125 or to that would be from 50 to 100. So, or 25 to 50 would be 100% gain. 50 to 100 would be a 400% gain, right? And now you go from 100,000 to 200. That's an 800% gain over 30 years. So let's get out the trusty phone calculator, the complete no-no to do on the radio, but let's try it out here. 800% divided by 30 years. That's 26.6% a year of inflationary appreciation on that real estate. Now, you're just not getting those kinds of gains anywhere. Now, the stock market might have done that also. The point I'm making is that all these other gains we get are alongside of the very same gains that the stock market gets through long-term appreciation. They're both there. And they occur simply because of inflation. I mean, the value appears to go up in both the stock market and real estate when it's really just the inflationary dollars worth less. And that's why these things cost more. But all the other assets that we talked about today, all the other reasons we talked about today of why this stuff went up in value, you're not getting with the stock market. And that's the difference. That's really what it all comes down to, is that you get all these other things: safety, security, physical asset that doesn't run away, can't be lost, to cash flow that you can live on, you can retire on, actual cash flow. Unbelievable. The ability to buy and make instant gains by equity capture, or the ability to force the value to go up through forced appreciation. The depreciation deductions and the tax benefits yearly. Doesn't wait. It's like, well, my 401k, I get out of paying tax. No, this every year you're getting money back from the government. That's extra cash flow because of these tax reductions. The mortgage reduction added to the appreciation, and voila, you're rich. Your net worth has skyrocketed. All of this because you made the decision to look into how to purchase and manage real estate effectively and to get away from just the standard rat race investment, which is the wheel. Get on the wheel and run. Put money in a 401k for the rest of your life and then retire someday hoping there's still money there and then hoping you'll die before that money runs out. If you don't like the little wheel, then go to the cubicle. The cubicle prison is the same thing. Go to work every day for the rest of your life in the cubicle prison. Put your money in your 401k. Hope that it's still there when you die or when you get ready to retire. And if it is, hope that you die before you run out of money. There it is, folks. 33 years later, I'm massively wealthy, along with thousands of other people that have listened to what I've said. It's your chance, folks. It's your chance. It's your time. You should be doing this too. When is the best time to do this? 30 years ago was the best time to do this. When was the second best time to do it? Let's start today. Have a great day, and remember, folks, it's not the money, it's the lifestyle.
The information and opinions you hear on the Del Walmsley radio show are those of the host, Del Walmsley, his guests, and his callers. The Del Walmsley show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Del Walmsley show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.